Hi, I'm Sheila Darby, a Managing Director here at BizWorth. Thank you for joining me for today's video on how to value a business. We're going to focus on the market approach today. We've previously covered two other approaches. We've covered the asset approach and we've covered the income approach. And today we're going to focus on the market approach. So what exactly is the market approach? The market approach is valuing a business based on references to other comparable guideline companies. Those could be either public or private, but you're looking for companies that are comparable. So let's walk through what the advantages are for the market approach. The market approach is considered by many to be user-friendly. It's easy to explain. The market approach also uses actual data from real transactions. It's relatively simple to apply, and it does not rely on explicit forecast for a company. So if a company such as your own doesn't have reliable forecasts or projections for the future, then the market approach may be helpful to use. This is also somewhat similar to the rules of thumb approach. Many people will hear from the market that they need to use a 6 times revenue to value their company or 2 times revenue. Those are all rules of thumb. Now, those are rules of thumb based on information and that have hopefully been compiled over the time. Industries may have rule of thumbs, but the market approach is different from that. You're using actual transactions from private or public firms, and you're using that information to place a value on your subject company, on your business. There are disadvantages to the market approach. Sometimes for a particular business in a particular regional area or a particular industry, there are no good comparable companies, either in the public sector or the private sector. The standard of value may also be unclear. On another video series, we'll cover the standards of value. There are 3 standards of value. You have fair value, fair market value, and investment value. So sometimes those standards of value can be unclear. The most important assumptions may be hidden. They may not be covered during the review. It's also a costly approach. And the reason why it's costly is because the publicly traded companies, that information is somewhat readily available. However, the private transactions, those are captured by companies that sell the information based on subscriptions, and that is very costly. Now, here at BizWorth, we have subscriptions to pretty much every possible database there is on private transactions, but this is a very costly approach. It's also not as flexible or adaptable as the other approaches. And sometimes the reliability of the information can be questionable because the information is submitted oftentimes by either brokers or bankers to these companies that have these subscription-based databases. Now that you've decided to use the market approach, how do we use it? There is a basic formula. This is it. So we're going to cover this formula. The value of a business, of the subject company, is based on the price of the comparable transactions divided by the parameter multiplied by that parameter of your subject company. Now, this isn't going to make a lot of sense at this point, but let's break down each one of these and explain them more clearly. The first is consider the pricing multiple. The pricing multiple consists of the price of the comparable transaction. It could also consist of the median value of a set of data, or it could be the average of a set of data. I won't go into and discuss the pros and cons of using one transaction, multiple transactions, or whether you use the median or the average, but just know that the price in the numerator is of the comparable transaction, the price in which it was sold. And then for this, I thought it'd be helpful to talk about a bakery that we did in North Texas several years ago. The sell price of this particular company was $270,000, and the annual revenue of the comparable company, this is a comparable bakery sale of a bakery that we looked at in North Texas, and the annual revenue of this comparable bakery was $600,000 year in and year out on average. So again, this comparable bakery sell price $270,000 with annual revenue of $600,000. The private company transactions, there are again, lots of different databases you can have subscriptions to, but here are some of the most common ones: the Institute of Business Appraisers, IBA, DealStats, ValueSource, MergerStat. And some of these databases, these companies are purchased by other companies, so their names can be ever changing, but these were the names of the businesses on the date of this video. And we walk through what these different sources are good for. Some are good for very small companies, others are good for more medium to small businesses, and others have a good mixture of publicly traded companies in addition to privately companies. But you have to know what the different databases are good for and what information they have. The denominator is the parameter. And what exactly does that mean? The parameter is in the denominator of the pricing multiple, and it's the financial statement parameter for the comparable company. So let's talk about what that is. What can the different parameters be? It could be revenues, gross profit. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. You have EBIT, debt-free net income, and the list goes on. So back to our example. The comparable bakery sale that we found, the sale price was $270,000. The annual revenue was $600,000 for this company. Here, the revenue is the parameter. So the particular bakery that we valued in North Texas, your bakery, the annual revenue was $80,000. So you want to know what the parameter is for your company, for the subject company. And so let's apply the information that we have. We know that the price of our comparable bakery was sold at $270,000. The annual revenue was $600,000. And when you take that and multiply it by our company, $850,000 revenue, you come up with the value of the business, $382,500. And this is a value for this particular example based on one comparable company. And like I said, we could have a whole nother video series discussing how many comparables is good, one or many, should they be private or public, should you use average or median? And there is lots of information out there, lots of good approaches, and sometimes the circumstances of your particular case will dictate what's the best approach. So I hope this video on the market approach is helpful. And we've now covered all three approaches. We've covered the asset approach, the income approach, and the market approach. We have covered methods under each approach under this video series. So if you found this to be helpful, please share the video. Please follow us on Facebook or LinkedIn and subscribe to our YouTube channel. But if you have any questions or you'd like us to value your business, please come to our website at bizworth.com and schedule a free consultation. Thanks so much.